Thank you, Shokji. Hello, everyone. Good morning.
Good morning.
So let's wait for a minute and then we will start with the session for today. Okay, so I think we should start now. Okay, a very warm welcome for today's session. I hope you are revising whatever sessions, whatever discussions we are doing in the sessions. At home, you are doing some revisions. So in the last session, we were talking about the diluted earning per share, right? So basic earning per share and diluted earning per share, we have done a couple of numericals around them. So let me reach diluted earning per share, right? So what we have understood in our previous session is that diluted earning per share uh, is a earning per share post adjustment of the potential ordinary shares, right? So any instruments which are in the nature of convertible into the equity shares at some future date, right? So those instruments we need to adjust, right? And diluted earning per share should be always dilutive, right? It cannot increase as compared to the basic earning per share. If it increases because of any of these adjustments, right, then we will ignore those, right? So that's what we had discussed in our previous class. Now, then we have also discussed the 6 steps which we need to follow in order to compute the diluted earning per share, right? And I did mention that if we are calculating the diluted earning per share, we need to, uh, properly understand the ranking of these potential ordinary shares, right? From the smallest to the largest, right? So that is a crucial step which we need to do while calculating the diluted earning per share, right? Because this tells us which items are dilutive and which items are anti-dilutive, right? And we need to ignore all the anti-dilutive items, right? Once we are done with the ranking correctly, then we will simply compute the basic earning per share and then diluted earning per share, right? So relatively the remaining steps are easy. The crucial step is this one only, right? So if we do the ranking properly, we will do no mistakes in calculating the diluted earning per share, right? Then we did a numerical as well around this. Let me go to that numerical, right? So this was the numerical which we did in previous session. There were all in all 3 items, right? Uh, which we have adjusted for the purpose of calculation of diluted earning per share. And we did the ranking for these 3 items in this table, right? Basis on the results they are producing, right? So this is, giving me a 0 answer. So the rank is 1, then the second largest and the largest, right? So in this order, we are doing the ranking, right? The ascending order, right? And basis that we have computed the diluted earning per share here, right? So did you get a chance to revise this concept at home after the session or this numerical, or in case there is any query anybody has?
Yes, I have revised the question,
Mm-hmm.
and I had a query about that conversion. So I was
Conversion.
reading this standard. Can I read this line?
Mm-hmm. Which one?
I will read from the study material. This says the difference between the number of ordinary shares issued and the number of ordinary shares that would have been issued at the average market price of ordinary shares during the period shall be treated as an issue of ordinary shares of no consideration.
Mm-hmm.
So there was some confusion around this 4,50,000 options which we calculated.
Right. Right.
So I did it. I could understand later how we can do it.
Mm-hmm.
So you did it in
So,
a different
so
way.
let,
I
let
did.
me let me clear that because I picked up the numerical first, and I am about to touch base the concept which the standard has, right? Which we actually used in that adjustment, right? So maybe I can start with that concept first, right? And then we will see how we have adjusted for that option, right? So the option, third item you are talking about, right?
Yes.
Correct.
Options.
So,
Yes.
right. So standard says options, warrants, and their equivalents, right? So any such instruments which carry the right, to the holder to ask for equity shares from the company are called, these type of instruments named differently options, warrants, or by any other name called, right? Now, options and warrants are dilutive when they would result in the issue of ordinary shares for less than the average market price of the ordinary share during the period. Now, when we read this statement, what is the meaning we are able to draw from this? So, this statement says if option is exercised by the holder of the option, right? And he is getting the shares at a price which is less than the market price, right? Then only it is beneficial to the holder, yes or no?
Yes.
Right? So if it is beneficial to the holder, then it is at somebody's cost,
Yes.
because if one party is getting the benefit, then other party must be bearing that cost, right?
Right.
So at the cost of the company's owners, right? Although the company's share price is say rupees 11, right? In our example, if I correlate, so fair market value, right? In our question was how much? 11. But the shareholder or the option holder was getting the shares at
9.9.
9.9, correct?
Yes.
So 1.1 was the delta,
Yes.
right? Now this 1.1 per share benefit is getting passed on to the option holder at the cost of equity shareholder, existing shareholders of the company.
Yes.
Yes, until now we are on same page.
Yes.
Now standard says, can we compute the number of shares which is equivalent to the value of the benefit passed to the option holder, right? Then how many options were there? 4.5 million
Yes.
into May. What is the benefit per share? 1.1,
1.1.
right? How much it comes? 4.5 million. Sorry, 0.45 million. 4.5,
4.9. 4.95.
4.95 million, right?
9.95. Yes.
Right? Now,
Yes.
what this 4.95 means to you? So this 4.95 is the number or it is the value?
Value.
It is the value, because how we are calculating number of options 4.5 million into May benefit per option or benefit per share is 1.1 rupees, because 1.1 is the difference between the fair market price of one share and the exercise price of one option, right? So 1.1 rupees is the benefit getting passed on to the option holder, right? on each share. So 4.5 is the million is the number into my value. So 4.95 million is the amount, correct? Or dollar in our
Yes.
question. Now, what is the fair market price divided by 11? How much it comes? 4.5 lakhs.
Yes.
4,50,000, correct?
Yes.
Now, what this 4,50,000 means? This is the number of shares.
Yes.
Now, another doubt comes, are the number of shares 4,50,000 getting issued or the 45 lakhs shares are getting issued, right? So standard says whenever the shares are issued to any option holder or any warrants holder or any other equivalent instrument holder, then there are actually two transactions happening, right? Number one, some shares are getting issued at the average market price and some shares are getting issued for no consideration, correct?
Yes.
Because he is getting the shares at a discounted price, right? So what we have done until now, we have calculated the total amount of discount, right? Divided by the fair market value. So it gives me the number of shares which are getting issued to the option holder for a free, right?
Yes.
Clear?
Clear.
Now, standard says the number of shares which are getting issued at the fair price, right? That is 11 rupees only or $11. They are assumed to be fairly priced. They are neither dilutive nor anti-dilutive because
Yes.
they are getting issued at fair price. Hence, we need to ignore the calculation of this issue in the diluted earning per share. But the number of shares which are getting issued for a free, right? So they generate no proceeds or no cash for the company, right? Hence, these become dilutive because earnings for the equity shareholders remains constant, right? Divide by denominator is getting updated existing shares plus new shares which are issued for a free, right? So only the shares which are issued for a free will be added in the denominator, right? So these shares are added and then we calculate the diluted earning per share, right?
Right.
So I remember when we were doing this question because we were at the top of the hour and you asked that what about these shares, right, which are getting issued, right, by virtue of this transaction, right? And I said that they are ignored, right? So that is the concept. So standard says there are two transactions actually merged within the one transaction. So we need to segregate these two, right? One is the number of shares which are getting issued at a fair price, and one is the number of shares which are getting issued at no consideration because these shares, this is the number of shares which is equivalent to the benefit which is getting passed on to the option holder, right? So these number of shares we only calculate and consider for the diluted earning per share purposes. Now, my question to all of you, are these shares actually getting issued?
No.
No. So what we are doing here, we are in a hypothetical world, right? So I repeat, whenever we calculate the diluted earning per share and what all potential ordinary shares adjustments we do, all that is done with a hypothetical situation mindset, right? The transactions are not actually taking place with the company, right? It is only our assumption that if these transactions take place, then what would be the adjusted numerator and what would be the adjusted denominator, right? And we calculate the diluted earning per share, and all these adjustments are restricted strictly restricted to the calculation of this diluted earning per share only. We are not saying that these transactions are actually taking place, right? So they will take place certainly at some future date, right? But we are adjusting these, you know, assuming they are taking place. If they take place, what would be my EPS? And that would be EPS is actually given another name, diluted EPS. Is that clear? So diluted EPS concept is a hypothetical concept, right? So basic earning per share is the real earning per share the company is having as on today's date, and diluted earning per share concept is a refined version of basic earning per share, assuming if the company holds any such contracts which, if exercised result into additional flow of shares, right, then what would be the desired EPS of the company? So that desired EPS is the diluted EPS, right? And we are not doing any accounting for any of these transactions anyway, right? I think that is now very clear to everybody, correct?
Yes,
Now,
clear.
any other question on this?
No.
Others? Okay. Now I need to discuss one more concept on the diluted earning per share before I proceed further, right? So this is all we have discussed. Let's quickly read the slide. This I have just, put it up here for your revision in exams. For the purpose of calculating diluted earning per share, an entity shall adjust. Shall means mandatory. Profit or loss attributable to ordinary shareholders of the parent entity after the tax effect of any dividend or other items related to dilutive potential shares is deducted in arriving at the P&L for the equity shareholders. Any interest recognized in the period related to dilutive ordinary shares and any other changes in the income or expense. Do you remember the adjustments for the bonus, management bonus? The management bonus, which we adjusted, we did one numerical.
Yes.
And you have asked the question as well that why we are adjusting this management bonus. And then I said, assuming these transactions are taking place, management bonus would have been computed at the P&L, right? Profit of the company, and then profit is getting revised because of these transactions, and hence management bonus portion also needs to be revised. So this is written in the standard with this language, right? Any other change in the income and expense that would result from the conversion of the diluted earning per share. So because the diluted potential ordinary shares are getting converted, and because of that, if they are impacting any other item of income or expense in my PNL, and then that impact also needs to be adjusted in the numerator, right? And what we are doing in the denominator, potential ordinary shares we are computing. So financial instruments or other contracts that may entitle its holders to any ordinary shares, for example, warrants, options, convertible preference shares, convertible bonds, convertible debentures, or any other instrument by whatever name called, having the effect to affect the denominator. Assumptions of the conversion at the beginning of the period, or if later, at the date of the issue, right? So what does this mean? So at the time of the issuance of these options, warrants, or convertible preference shares, the condition or agreement says that one preference share will be converted into two equity shares, right? So that was the original agreement between the company and the preference shareholder. Now, at the time of the conversion, if the company says that instead of two, I will give three equity shares for one share, then what adjustment you will do in the denominator? By the two shares or by the three shares?
3 shares.
By the three shares, because we will take effect of the latest terms and conditions if any of them are getting revised, right? Now, on which date we will, take the effect? Suppose if we are preparing the financials of 31st March, right? And by that time, company has already amended the terms, then we will see the amended terms only, right? But if the company has not yet officially amended, or they are not formally approved, then we will not consider, right? So we always need to ask management, because shareholders agreements are sometimes 5 years old, sometimes 10 years old, and there might be amendments to those terms and conditions or agreements. So before using whatever the information is available in the main shareholders agreement, we should always ask the management if there are any amendments to this, right? And basis on that amendments, if any, we need to consider the adjustments, right? Then the third item says assumption of the conversion at the most advantageous rate from the holder's standpoint. Who is the holder? The third party, right? The person who is actually holding the options or warrants, right? So let's do understand this. On 1st of January, shares in issue, how many? 10 lakh. Profit for the year ended 31st December, 2 lakh. On 31st March, the entity issues 2 lakh 6% convertible bonds with the terms of conversion 100 shares per $100 if converted within 5 years, and 110 shares per 100 if converted after 5 years. Tax rate 33%. Basic earning per share would be 2 lakh divided by 10 lakh 20 cents. Calculate the diluted earning per share. Do you want to try once? I hope your calculators are ready. And question is very simple. So just try what the logically you are able to come up with, and then we will see what the standard is saying. Any luck with the answer? Anybody? No answer?
0.17, I mean 17.
Right. So how many number of shares we had? 10 lakh. Profit given in the question, 2 lakh. Now dilution shares we need to compute now. So we will use 110 among between these two terms, right? Which is more favorable
110.
for company or holder,
Holder.
right? Always remember, from the perspective of the holder, which term is more beneficial, right? So 110 shares term is more beneficial because it will eventually, you know, fetching them additional equity shares, right? So we will use the 110, right? Then 2 lakh was the number of convertible bonds, right? And into my, uh, 2 lakh was the value. So divide by 100. So 2000 was the number, right? Into my 110, into my weight, 9 by 12 for the period. So it gives me 1,65,000 number. So total number of shares denominator is 11,65,000, right? And on 2 lakh bonds, 6% interest for the 9 months into my tax adjustment. Tax adjustment is given in the question, 33%, right? So into my tax adjustments, 1 minus tax rate, 1 minus tax rate, correct? This is what we do. So this amount will be adjusted in the numerator. Will this be added or deducted? Added, correct?
Added. Yes.
Because this was already debited in my profit, right? As an interest expense, correct or not?
Correct. Yes.
Correct. So I am now adding back because these debentures are eventually getting converted into equity shareholders. So interest is renounced. There wouldn't be any interest cost anymore to the company, right? So that's why it is added. So this is the numerator. Now numerator divided by denominator. 17.68 cents. Clear? So what the standard says? The standard says assumption of the conversion at the most advantageous rate from holder's standpoint, right? So always remember from holder's standpoint, correct? Then the another item, treated as dilutive only when conversion would decrease the net profit or increase the loss per share from the continuing operations, right? So if the company has both continuing as well as discontinued operations, then whether we will consider the effect of dilution from the continuing operations perspective or discontinued operations perspective or the net income perspective, continuing operations, right? So who you investor or anybody who is looking at the future prospects of the company would be interested in knowing what is happening on the discontinued operation, or he would be more interested in what is happening on the continuing operations. What do you think?
Yeah. For the continuing operations only.
Continuing operations. So if we are computing the diluted earning per share, then the dilution, and I mentioned that dilution, we while calculating diluted earning per share, we always need to consider those instruments which are dilutive in nature, right? So if they are dilutive on continuing operations, then only we need to consider, right? If they are anti-dilutive on continuing operations, or they might be dilutive at discontinued operations, then we need to ignore, right? Now I know without practical, it is not easy to understand, right? So let's do one practical on this as well. Let me. So let's do this question first, and then we will come back to the literature. Assume the following facts for the company XY. Income from continuing operations 30 lakh. Loss from discontinued operations 36 lakh. Net loss 6 lakh. Clear? Facts. 30 lakh is the profit from continuing operations and 36 lakh is the loss from discontinued operations. So overall P&L of the company is 3 lakh, 6 lakh negative. Clear? Weighted average number of shares outstanding for the company is 10 lakh. Incremental common shares outstanding related to the stock options is 2 lakh. You are required to calculate the basic and the diluted earning per share for company XY from the above information. Assume if in above case loss from continued operation is 10 lakh and income from discontinued operation is 30 lakh, then also calculated the EPS. So scenario 1 and scenario 2, right? So first of all, you try your hands on scenario 1, ignoring the scenario 2. What is your answer? Basic and diluted earning per share for both. So what you need to say for continued operations, for discontinued operations, and for total? What is the basic earning per share and what is the diluted earning per share, right? So can you calculate quickly this? What's the answer? I think it can be done even without calculator.
Yes, we have to ignore the loss from discontinued operations. So we will take 30 lakhs upon 10 lakhs weighted average number of shares. So it comes to 3 rupees.
Okay.
Basic earnings, basic earnings.
Mm-hmm.
So diluted will come 30 lakhs and incremental common shares outstanding to stock options is 2 lakh. 32 lakhs divided by no, 30 lakhs divided by 12 lakhs.
Look at
2.5.
okay. So 30 lakhs divided by 12 lakhs, 2.5 you are saying. Okay. Then discontinued.
For this, we have to calculate separately without considering income from continued operations.
Of course.
Okay. So basic comes to 3.6.
Mm-hmm.
And 3. The EPS 3.
3. Yes.
Okay. And one more item. Total. What is the total? So net income approach. What is the basic and diluted?
The 0.6
Okay.
basic.
And diluted.
0.5
Okay. So these are your answers for this scenario one. Or do you want to change anything? Okay. So let's lock for scenario one. Now, scenario two. Assume if in above case, loss from continued operation is 10 lakh, right? So instead of 30 lakhs, it is 10 lakhs negative. And income from discontinued operation is 36 lakhs, right? So instead of 36 lakh loss, this is 36 lakhs profit, right? Then what would be the net position? 26 lakhs profit, correct?
Yes.
At the P&L. Now, what is your answer for basic and diluted for all the three? Basic, diluted, and total. Sorry, continuing, discontinuing, and total. So same logic, 10 divided by 10 minus 1, 36 divided by 12, right? You would be doing 3, right? And again 26 divided by 12, right? That's what you would be meaning, correct?
Yes.
So if life was so simple, so what standard says, now we will understand. So step 1, basic earning per share is the profit for the year divided by weighted average number of shares outstanding. So this is the formula we already know, right? Now, basic earning per share from continuing operations is equal to profit from continued operations divided by weighted average number of shares outstanding, right? So profit from continuing operation is 30 lakhs divided by 10 lakhs. So 3 rupees. So here the answer, our answer is correct, right? So that's what we have done. Then
Yes.
basic loss per share, discontinued operations. Loss from discontinued operations divided by weighted average number of shares outstanding. 36 lakhs divided by 10, 3.6. Loss is per share from discontinued is 3.6. This answer is also correct for us. And then overall, that is the total P&L level. The loss is 6 lakhs divided by the 10 lakhs, 0.6. The answer is correct, right? So these three answers are correct for us, correct? Now, when calculating diluted earning per share, diluted EPS, profit for the year, adjusted weighted average number of shares. EPS from continued operations, profit from continued operations divided by weighted average number of shares. So 30 lakhs divided by 12 lakhs. So 12 lakhs, 2 lakh is the additional number of shares, resulting in no change in my numerator because nothing is given in the question, right? So we will assume no impact on numerator, only the denominator is getting increased, and hence we are adjusting the denominator 2.5. Our answer here is also correct, right? You mentioned 2.5. Now, loss per share, discontinued operations. So, loss from discontinued operations adjusted divided by adjusted weighted average number of shares. So, again, 36 lakh by 12 lakhs, 3 lakhs. Here also answer is correct. Overall, 6 lakhs divided by 12 lakhs. Here also answer is correct. So, until now, we are done with. So, for the scenario one, our basic as well as diluted earning per share is easy and correct, right? Whatever we have computed. Now, for the scenario 2, we will see what we need to do. The income from the continuing operation is the control number, right? There is a dilution in the basic earning per share for the income from continuing operations, that is reduction of EPS from 3 to 2.5, right? Here it is 2.5 and here it was 3,
3.
correct? So because my basic earning per share is getting reduced from 3 to 2.5, right? Therefore, even though there is an anti-dilution, loss per share reduced from 0.6 to 0.5 as calculated above, diluted loss per share will be 0.5 reported. Now, while calculating and answering this, did you thought about this? No.
No.
You simply calculated and luckily your answer was correct. Correct? Because the standard says if my basic earning. So, okay. So there are three earning per share. One is basic earning, one is diluted earning per share, and one is the total earning per share. इतना तो हमें clear है, right? If
Yes,
the
yes.
company has discontinued operations, then there are three categories of earning per share needs to be calculated and reported, right? Now standard says which earning per share is our control number? Basic, right? So standard
Yes.
says basic earning per share is our control number, right? If basic earning per share after adjustment of the dilutive instruments is getting reduced if it was positive or getting increased if it was negative. Did you understand what I mean to say? If continuing operations had a profit, right? Then if basic earning per share is coming 3 and diluted earning per share is coming 2.5, then it means this is decreasing. Yes or no?
Yes.
Yes. So it means it is getting diluted, right? So my control number is basic earning per share. And if basic earning per share was positive 3 and it is coming to positive 2.5, that is diluted. So it is a dilution. Now we will not see what is happening to the discontinued operation or the total operation. So discontinued operation and total operation, whether becoming dilutive or not, doesn't matter in this case because my basic is getting dilutive. So we will use the same basis for the purpose of calculation of diluted and the total, right? Another example, if basic was say minus 3, for example, and it was getting dilutive to minus 2.5, then what would be the dilutive earning per share in this case?
It's an increase of 50.
So instead of getting reduced, it is actually a increase. So we will ignore. So in this case, what would be my diluted? 3 only? Yes or no?
Yes, sir.
So unless and until minus 3 increases to minus 4 or minus 5, it is not dilutive, correct? So if it is going to minus 2.5, that is, it is getting increased, then it is a anti-dilutive. Are you understanding it? Yes or no?
Yes.
Right? So if if the company is having a loss from its continuing operations, right? So it will be having a negative earning per share from the basic for the basic earning per share from continuing operations. So in that case, after doing the dilutive instruments adjustments, we need to see whether it is actually increasing or decreasing, right? So if minus 3 is further reducing to say minus 3.5, minus 3.9, minus 4, minus 5, minus 6, right? So in that case, it is a dilutive. And if it is, increasing, then it is a anti-dilutive. And standard prima facie says that we will not consider the anti-dilutive adjustments for the purpose of calculation of diluted earning per share. So what does standard mean by saying this? So standard says if post dilutive instruments adjustments earning per share is instead of dilutive, it is becoming anti-dilutive, then what we will do? We will say basic and diluted earning per share are same, right? That's what we do. Even in our ICAI, we have been doing this. There is nothing new we are talking about today, correct? Until now, everybody is on the same page.
Yes.
Yeah. Yes? Or any questions? Because we need to understand this concept clearly first before we, proceed with other adjustment. Now the standard says, in case loss from continuing operations, the potential shares are excluded, since including those shares would result into anti-dilution effect on the control number. What is the control number? Basic earning per share from continuing operations. Correct? This is my control number. Loss from continuing operations. Therefore, the diluted EPS will be calculated as under. Diluted EPS is equal to profit for the year divided by adjusted number of shares. Loss from continuing operations plus gain from discontinued operations is equal to 10 lakh plus 36 lakhs is equal to 26 lakhs. So 26 lakh positive on the overall basis divided by weighted average number of shares. How many? 10 lakh. So diluted earning per share is 2.6. Why 10 lakh? Why not 12 lakhs? We are calculating the diluted earning per share and we are not considering the 2 lakh additional shares. Why? So until now,
Because it increases the profit, na sir.
right. So until now, we understood that whenever we calculate diluted earning per share, we need to increase the denominator by the additional number of shares. But in this case, we are not doing so. Because what is happening over here? I have a loss in my continuing operations, right? And loss divided by weighted average number of shares, I have computed as a basic loss per share, right? That basic loss per share is actually getting reduced if I increase the denominator. Hence, it is becoming anti-dilutive. Because it is becoming anti-dilutive, so I'm not considering those additional shares for the purpose of calculation of my diluted earning per share, and hence I am ignoring them. So what I'm doing, my 10 lakh loss divide by 36 lakh discontinued profit, add the total P&L picture 26 lakhs. So 26 lakhs divided by 10 lakhs, 2.6 would be my diluted earning per share. The dilutive effect of the potential common shares on the EPS for income from discontinued operations and net income would not be reported because the loss from continuing operations. Another important point. What this says? This says if the company has loss from continuing operations, then it is not required to report the basic and diluted earning per share separately for the discontinued operations, because its continuing operation is into losses, right? So no reporting is required for discontinued operations, irrespective of the fact discontinued operation is profitable or loss making. It doesn't matter. The main operations are loss making, so that's enough. Clear? So okay, let's summarize what all we have understood now until now on the diluted earning per share, right? So let's quickly revise. First of all, we know the concept that basic and diluted earning per share needs to be reported for continuing operations, discontinued operations, and the total, right? Number one. Number two, diluted earning per share means when basic earning per share, if profitable, is getting reduced, and if it is loss making, it is getting increased. The loss per share is getting increased or the profit per share is getting reduced, then only we say it is dilutive, right? So if reverse is happening, right, then it is a non-dilutive. In that case, my basic as well as diluted will remain same, right? So I will not present my dilutive earning per share because it is not dilutive, it is anti-dilutive. What I will say, basic and dilutive earning per share equal to, and whatever the basic earning per share is coming, I will present that. So in that case, one line disclosure is generally made. Basic earning per share and diluted earning per share, right, is equal to whatever the basic earning per share I have calculated, right? And in the notes, I will mention that if we calculate the dilutive earning per share by giving the effect of the potential ordinary shares, it is actually resulting into the anti-dilution and hence ignored, right? So that is the note disclosure we will clarify, and on the face of the PNL, this will be disclosed, right? Now, for the purpose of calculation of diluted earning per share, we have discussed that we need to follow these steps, right? What are these steps? First of all, we will list down all the potential ordinary shares which the company has, you know, which can be issued in future, right? Then we will calculate incremental earning per each class of these potential ordinary share. Then we will rank them from 1 to 10 in the ascending order, smallest to largest. Then we will calculate the basic earning per share from continuing operations, and then one by one we will see which one is dilutive, and the ones which are dilutive only needs to be considered, and basis on that we will calculate the diluted earning per share, right? Until now everything is clear,
Yes, clear.
right? Then once we are done with this calculation, right, then we will see if the company has any uh, discontinued operations as well, right? So continued operations calculation is done. Now, if the company has discontinued operation as well, then we will calculate the uh, basic and diluted earning per share for the discontinued operations and the total operations, right? So all these calculations are done in our working notes, right? Now we will see that for a company which is having a positive continuing operations, that is the profit from continuing operations, the rules are all okay. So whatever we have calculated is all okay. But if the company is not having a profit but having a loss from continuing operations, then the situations get changed, right? Because there is a different rule book, is getting applied for that situation. So standard says if the company has a profitable continuing operations, then the normal approach you need to follow, no issues, right? That's we already understood. But if the company has loss from continuing operations, then the standard says that the rules change. What the standard says here? Standard says, first of all, you need to see whether adjusting the denominator will result into increasing the loss per share from continuing operations or decreasing the loss from continuing operations per share, right? So if it is increasing the loss, then only it will be a dilutive, otherwise not, right? So because in this example, it is actually decreasing the loss, right? So hence we have ignored the 2 lakh shares for the purpose of calculation of diluted earning per share, and we continue to use the 10 lakh shares. Until now, everything is clear? Yes, no?
So if the loss is decreasing, then we will ignore you're saying we will
So,
ignore if the
so,
loss is
so, so my loss is how much from continuing operations? From continuing operations, the loss is 10 lakhs, right? 10 lakhs
yes,
given in the question. Here it is. The second item, second scenario I'm talking about.
yes,
10 lakh and 36 lakh is the profit from discontinued operations, right? So if I calculate the basic earning per share, so 10 lakh divided by 10 lakh minus 1 rupees per share. This would be the basic earning per share from
yes,
continuing operations.
yes.
Now, if I calculate the diluted earning per share from continuing operations, then my loss is how much? 10 lakh divided by my number of shares would be how much?
12,
12 lakh. What would be the answer? Minus, can you calculate?
0.833. 0.833.
0.833. Now, how many of you believe 0.833 is a larger loss per share as compared to 1 rupee loss per share. So it is more loss or it is less loss?
Less loss.
Less loss. So if I have 1 rupee loss per share as a basic loss per share and as a 0.8 rupees loss per share as a diluted loss per share, then it is a dilutive or it is anti-dilutive?
Anti-dilutive.
It is less loss,
Anti-dilutive.
anti-dilutive.
Anti-dilutive. Now standard has a clear rule book. If it is anti-dilutive, we need to simply ignore
Yes.
this adjustment. So what adjustment we made? 2 lakh shares. So we will make it back to 0.
10.
So what would be my diluted earning per share in this case?
Same.
Same. So what I
Minus
will
10.
report on my P&L? Loss
Both.
per share and diluted loss per share for the year ended minus 1. Is that clear?
Clear.
Now, standard says another thing, that basic loss or basic earning per share is always a control number from continuing operations, right? So whatever the company is earning from continuing operations is the control number. Now, then what control number means? Control number means we need to apply our dilution or anti-dilution rule book on the control number only, right? Now, in this case, what is happening? In this case, if I calculate the basic earning per share for my discontinued operations, then what would be that? 26 lakh, 36 lakh divided by 10, right? How much? 3.6. And if I calculate 36 lakhs divided by 12, how much it is? 3,
3.
right? So my basic earning per share from discontinued operations is a positive 3.6 and my dilutive earning per share from discontinued operations is a positive 3. Now it is a dilutive or it is anti-dilutive?
Dilutive.
Dilutive. Now in this case, because my continuing operations is in loss, right? And anti-dilution is not dilution is not happening at the basic earning per share level. So I will not consider this 12 lakh or 2 lakh adjustments. So for my discontinued operation as well, what I will do? I will make it 0. And my diluted earning per share for discontinued operation will also be 3.6 in spite of the fact that it is not anti-dilutive at discontinued operation level. Is that clear?
Yes.
Any doubts on this? So what is the thumb rule? The thumb rule is if the company has a profits in continuing operations, no tension, right? But if the company has losses in continuing operations, right? In that case, we need to see if at basic earning per share from continuing operations level, the dilution is dilution or the dilution is anti-dilution. Because if it is dilution, we will ignore. And once we ignore at the basic earning per share level, we will ignore at all the levels. Yes or no?
Yes.
Right? So the standard says that whenever my control number is anti-dilutive, we will stick to the basic earning per share weighted average number of shares, right? And by doing so, how much the total operations the company has? 26 lakhs is the profit, 10 lakh negative, 36 lakh positive, 26 lakh. 26 lakh divided by 12 lakh or 10 lakh? 10 lakh.
10
So
lakhs.
2.6 would be my diluted earning per share. And also, in this case, the dilutive effect of the potential common shares on the EPS of the company from the discontinued operations and net operations would not be reported because the loss from continuing operations. So that is the another thing the standard is saying. First of all, the calculation mechanics, and number 2, the presentation. So standard says if the company has loss from continuing operations, it needs to present only what? What needs to be presented in that case?
Continuing operations.
Continuing operations, basic and diluted earning per share, right? So it
Yes.
is not required to present the discontinued operations in that case separately, right? In the notes, it can explain why it is so, right? Why it is anti-dilutive, right? So that's the standard asking. Clear? Okay, let's do one more numerical. I know unless and until we do good number of numericals, we will not be getting it right. So let's do this one. ABC Limited has 1 lakh rupees 1 ordinary shares and 1000 rupees 110% convertible bonds issued at par. Each convertible into 20 ordinary shares on demand, all of which have been issued in whole of the reporting period. ABC's limited share price is 4.5 per share and earnings for the period are 5 lakh. Tax rate is 21%. Calculate the basic earning per share, earnings per incremental share for the convertible bonds and the diluted earning per share. Ignore the requirements of Ind AS 109 for the purpose of this question. Okay. So this is the question. So you need to compute 3 items. Number 1, the basic earning per share. Number 2, the incremental share for the convertible bond. Number 3, the diluted earning per share. Would you like to try your hands on this?
Yes.
Okay, so I'm giving you 5 minutes. Just read the question carefully again and then try.
Basic earning per share 0.5
Mm-hmm.
and incremental shares are 10 lakhs 20,000
Mm-hmm.
and dilutive share 0.497.
Okay. Any other answer? See, in this standard, majorly, there are two concepts, on which numericals or questions in the examination to be asked is having a high probability. Number one is the rights issue, and number two is the diluted earning per share, right? Because rest all things are easy. So just do a good practice on the rights issue and the diluted earning per share calculations for different scenarios.
What is the use of this share price for rupees 50 paisa per share?
Where it is 50 paisa?
In the second panel.
Share price is 4.5 per share. So if you are not able to find any use, you can ignore.
Okay, I have got the same answers.
Okay.
0.5,
Okay.
0.498.
Okay. So let's see. The basic earning per share would be a 0.5, relatively easy, right? So 5 lakh divided by 10 lakh, right? The earnings per share earning per incremental share for the convertible bond is calculated as follows. Earning is effect number of bonds into my nominal value into my interest cost into my 1 minus applicable tax rate. This is the formula. How many number of bonds are there? 1000, right? What is the face value or the nominal value? 100. What is the coupon rate? 10% into the tax effect, right? So 7900 is the amount.
Yes.
Which will be adjusted into the numerator earnings, right? So incremental shares calculation, assume all the bonds are converted to shares, even though these converts 100 worth of bonds into my 20 shares worth only 90 of rupees 90 and is therefore not economically rational. So this gives 1000 into my 20,000 additional shares, right? So 7900 divided by 20,000, 0.395 is the incremental earning per share, right? So this was also asked in the question that what is the first of all calculate the basic earning per share and also tell the earnings per incremental share, right? So earnings per incremental share is calculated in this way, right? So 7900 divided by the 20,000, that is the adjustment in the numerator divided by the adjustment in the denominator, right? And then diluted earning per share would be 5 lakh plus 7900. Why plus? Because this was the interest which was already charged in the penal, now getting added back, right? Increasing the earnings attributable for the ordinary shareholders and divide by 10 lakhs plus 20,000. So 0.498. Clear?
Yes.
Yes.
Now, back to your question. Why ABC's limited share price is given in the question, right? In spite of the fact it is not a information which is useful, right? So it often many times that in examination, the questions are flooded with unnecessary, irrelevant information, just, to divert the thoughts, right, of the students, because the purpose is to really check your concepts, right? So if there are any irrelevant information and you are just simply wasting time, right, because you are not very clear on your concepts, then it will eventually either lead your incorrect interpretation of the question, what exactly is being asked, what in the question, or unnecessarily wastage of time, right? So this is one of the tactic, when unnecessary information is given in the examination questions, right? And we simply think that we have not used this, why this was given, right? So if we are confident what we are doing is correct, then we can simply ignore and save our time. Clear?
Clear.
Okay. Let's do one more question before we proceed on the next concept. Entity A has an issue of 25,000 4% debentures with a nominal value of rupees 1. The debentures are convertible into ordinary shares at a 1-to-1 at any time until 2009. The entity's management receives a bonus based on 1% of the profit before tax entity A's results for the 2002 showed profit before tax 80,000 and profit after tax 64,000. For simplicity, a tax rate of 20% is assumed in this question. Calculate basic earning per share and diluted earning per share, or maybe earnings for diluted earning per share only, right? Although we can calculate both, no, number of shares is not there in the questions, so we cannot calculate. So we can only calculate what is the numerator for the DEPS. I think this is the same question which we did in our previous session as well, right? Where we did the adjustment of the management bonus, correct?
Yes.
Right. So I think now it is very clear, right? So whenever we are calculating the earnings available to equity shareholders for the purpose of calculation of the diluted earning per share, we need to give effect for all the changes in the numerator, right? For any profit or loss changes because of these instruments getting converted. So if these instruments are getting converted and it is impacting some other expense or income item as well in the my PNL, so I need to revise those income and expense items as well. That's what happening in this question, right? My management bonus, which was eventually being calculated basis on the 1% of the total profits, now because my total profits is getting revised because of these convertible instruments, so my management bonus will also be equivalently updated, right? So paying reduced management bonus, so I will make an adjustment for that. And since tax expense also is getting increased because of this, so I will make a tax adjustment as well, right? So always remember not to forget to adjust any other items of income or expense, whenever you are doing the adjustments to earnings attributable to equity shareholders for the purpose of calculation of diluted earning per share, right? So there are some rules which we have learned on the diluted earning per share calculation. I have discussed all of them. I hope you are just writing or taking notes as well for these important items, right? For example, ranking. We need, if there are more than one diluted earning per share instruments available in the question, then ranking is important. So if the question is having only one type of instrument adjustment, then ranking step is not required to be done, right? But if in the examination question there are more than one instruments which are impacting my dilutive earning per share, then ranking is important, right? Then we also need to see, because of this, is there any other item of income or expense getting impacted, right? If it is so, like in this case management bonus, then we also need to take effect of those adjustments. Third, whatever adjustments we are giving effect, always consider post tax. So there are two choices: either you always make a practice of 1 minus tax rate multiplier on all your adjustments, or present them separately, right? If you are not doing that, but don't miss the tax adjustment, right? Then once you are done with the numerator calculation, then you will update the denominator, and then you will see what is the final result, right? So if this final result is anti-dilutive, then it will be ignored and basic and diluted will remain same, right? And then we also discuss the continuing, discontinued, and the total operations, right? So if the company has discontinued operation, then it needs to calculate separately for continuing, discontinued, and the total, right? And the control number is the continuing operations basic earning per share. So we will see the dilution or anti-dilution impact only on the control number, right? So even if it is dilutive at the discontinued operation or the total level, doesn't matter. The control number is always basic earning per share from continuing operations, right? So these are the important items which we always need to keep in our mind in relation to calculation of these diluted earning per shares. It might be possible that all of these adjustments come in a single question and the question is awarded say 10 marks, 12 marks, right? So just be careful with all these adjustments and the order of these adjustments as well, right? Any questions? Clear? Whatever we have discussed until now?
Clear.
Okay. Few more points on the diluted earning per share. Contingently issuable potential ordinary shares, always include them on the same basis as contingently issuable shares in the basic earning per share from the date when the contingent event occurred or conditions satisfied. So, if you remember, in our previous session, we discussed that suppose if there is an acquirer company and there is an acquiring company, and acquirer company has agreed to discharge the purchase consideration in the issuing number of shares, right? And they said that because we are acquiring your new business today, so we are giving you say 10,000 shares today, but 2,000 shares we will give you only if we find 100 crores, cumulative profit in next 3 years performance, right? From the business we are acquiring from you. Possible, not possible? Possible.
Yes. Possible.
Then
Yes.
in that case, from which date this adjustment will take place for the purpose of calculation of diluted earning per share? The date when the event occurs. Yes or no?
Yes.
What would be that date? That is the completion of the 3 years and the performance results are available. Correct?
Yes.
So merely because event has not occurred, then can the management make some estimates that because in the 2 years we are almost done with the 90 crore profits, and because the condition is only for 100 crore, so because in 2 years we are done with the 90 crore, so applying the pro rata we will anyway reach 135 crore, and which will be more than 100 crore, so anyway we will meet the conditions, so let's adjust this instrument at the end of the second year. Possible?
No.
No. No management estimates, no assumptions, no presumptions, right? Unless and until the event occurred or conditions are satisfied, we will wait to adjust for any of these potential ordinary shares. Is that clear?
Clear.
Then, unvested employee share options with fixed or determinable terms treat as though vested. So, whatever the unvested options, what do you mean by vested and vested?
Exercised.
No. Vesting and exercising are two different items. 102 is done or not in this batch? Share-based
Yes. Done.
payments.
Done.
Done. So, what what vesting conditions you have learned there? What are the vesting conditions?
Sir, a vesting condition, for example, an employee have to work for 5 years to get an option for
Hmm.
each option. That's
Hmm.
the vesting option. The
Hmm.
employee who have completed the 5 years or more,
Hmm.
they are called the vesting employee, and who
Hmm.
have below, they are called unvested employees. Like that.
So, vesting conditions can be of two types: performance conditions and non-performance conditions. I hope you must have studied, right?
Yes, sir.
Performance conditions can be of further two types: market related, non-market related. Are you able to recall all this discussion you might have had
Yeah,
in
yes,
that
sir.
session? What are
Yes.
the market conditions?
Market conditions are like if the company will touch the profit, our sales will be at that much level.
Hmm. Profits. Profits, you said, right? So market condition is not dependent on the profits or sales. Market conditions means market price of the share. So if any of the vesting condition says that if the company's share price, crosses 150 rupees mark, then, the employees will be given the share options. So those conditions are called market conditions, which we ignore for the purpose of calculation of vesting, right? Are you able to recall this discussion you must have had?
Yes, sir.
Right? So market conditions are always ignored, right? Non-market conditions, for example, purely performance of the company, for example, sales, profitability, right? All these, KPIs, which are not linked to the share price performance on the stock exchange, right? So those are non-market conditions which are considered for the purpose of vesting condition satisfaction, right? Now, what vesting conditions are? Vesting conditions are two types: performance and others. Performance is this one: market, non-market. Market always ignored, non-market always considered. And the other one is the passage of time. Employee has to continue with the company for next 3 years. That is one of the vesting condition, right? So it could be a combination of various performance, non-performance conditions, right? Now, for the purpose of calculation of earning per share or diluted earning per share, what India's 33 says. So India's 33 says that any unvested employee share options with fixed or determinable terms, right? What do you mean by determinable? That is, which is not dependent on any future outcome. Determinable, that is, I know for a certainty that, this event is there, right? And if it is only left to the completion of desired service period by the employees, for example 2 years, 3 years, right, which is anyway the passage of time, right, but no event we are occurring, waiting to occur, right, then those shares are considered as vested for the purpose of calculation of diluted earning per share, right? We will do a numerical on this. Then interim periods, if the company is producing the quarterly results, right, or half yearly results, then how the earning per share will be computed or diluted earning per share will be computed? Then the standard says all the potential ordinary shares are calculated independently for each period presented, right? Figures presented in a year-to-date period may not be equal to the sum of the or the weighted average of previous interim EPS figures. So my question to you is on this: suppose Reliance is producing its quarterly results, right, for the Q1, Q2, Q3, and the Q4, right, and then the full year, right? In the Q1, the Reliance basic and the diluted earning per share has presented, say, 2 rupees and 1 rupee, 3 rupee, 2 rupee, and say 4 rupees, 2 rupees, and suppose say 3 rupees and 1 rupee, right, for these quarters. Then can you say that for the full year it would be the summation of these two: 4, 2 plus 3, 5 plus 4, 9 plus 3, 12 rupees, and 1 plus 2 plus 2 plus 1, 6 rupees? Is it
No,
doable?
no, that's wrong.
Is it doable? So for the full year, can you simply add the 4 quarters EPS and the diluted EPS to come up with the basic earning per share and diluted earning per share for the full year? Possible, not possible?
No, not possible. The
Why?
quarter four will be the final figures.
So you mean to say quarter 3 is not final?
No, I mean for the full year, quarter four will be the same figure. So 3 and 1 would be the basic and diluted earnings per share.
Okay. Okay. So you are saying the quarter 4 and the full year basic earning per share and diluted earning per share will be same. So instead of 12 and 6, you are saying that this 3 and 1 will be for the full year as well.
Yes, I think so. Yes.
So there are 3 options. Either for the full year, it is the 3 or 1, or it is the summation of 4 quarters, or it is a 3 into my 4 divided by 1 into my 4, right? So 12 divided by 4, or so 12 and 4. So only 3 options I have: option number 1, option number 2, and option number 3. What do you think?
Option 1.
How many of you agree? So this is the quarter 4 EPS or the full year EPS. So back to the drawing board, right? Numerator. When we calculated the quarter 4 basic earning per share, are we taking the numerator for the 3-month period for the quarter 4 or the full year? Okay, let me put it another way. Basic earning per share and diluted earning per share are the measures for a particular period, or it is always for the full year?
For the full period.
For the particular period. So when we calculate it for Q1, it means it is for April, May, June profitability. When we calculate for Q2, it means it is for the July, August, September profits. When we calculate it for Q3, it is for October, November, December profits. And when we calculate it for March, then it is for January, February, and March profits. Isn't it? Yes or no? Okay, forget about India's. Under the IGAP, have you ever seen that EPS and DEPS for the 2 quarters or 3 quarters or 4 quarters to be aggregated or summed up in order to come up with the EPS or DEPS for the year? No, right? So never. We will never, do the earning per share or diluted earning per share in this fashion by summing up for the EPS for the 4 quarters, or assuming because quarter 4 is for the will be the same. So quarter 4 is for quarter 4, not for the full year, right? So for full year means 12 months profits divided by weighted average number of shares. Quarter 4 EPS means 3 months profit by weighted average number of shares. Quarter 3 is uh, uh, 3 months profits for those respective quarter divided by weighted average number of shares, right? So this is how these are computed. And we also calculate the YTD numbers, right? So one is the for the quarter and one is the YTD as well, right? So YTD means Q1 and Q2 taken together, Q1, Q2 and Q3 taken together, and then Q1, Q2, Q3 and Q4 taken together, which is anyway will be the full year, right? So what the standard is saying, whenever we are calculating the earning per share or diluted earning per share, potential ordinary shares are calculated independently for each period presented. Figures presented in year-to-date period may not be equal to the sum or the weighted average of the previous interim EPS figures, right? So it is not the right approach. So what we need to do? Neither this approach is correct, nor this approach is correct, and nor this approach is correct, right? So we cannot do any sort of addition, right? Or multiplication. What we need to do? We always need to compute the earning per share and diluted earning per share by picking up the numerator and denominator for the period for which we are calculating. Is that clear?
Clear.
Basic earning per share and diluted earning per share for the current period and the prior periods are adjusted for the bonus, share splits, and the share consolidation. Are you able to recall this discussion we had?
Yes.
So bonus shares, share splits, and the share reverse splits, that is the share consolidation, are always adjusted for whole of the period, right?
Yes.
Correct. And the effects of the anti-dilutive potential ordinary shares are ignored. Correct. So these are
Yes.
the key points which I have summarized on this slide just for your quick and easy reference in your examination days, that what are the important points we always need to keep in our mind for diluted earning per share computation, right? Even if you are not taking notes, this slide will help you. Okay. So do you want to go for a break? You want to continue? Okay, let's have a break. No problem. So it's 8:30. So let's be back at 8:40. 10 minutes break. Break started. So let's understand how the employee stock options will be, considered for the purpose of calculation of diluted earning per share. So what employee stock options means? Employee stock options are the options which will be eventually, offered to employees to keep them motivated to continue with the company for the longer period, right? So this is a, tactic which the company use widely to, keep their employees, engaged with the company, right? So that they can, utilize the employees' full potential for the benefit of the company, right? Because if there is a high labor turnover, then company will eventually end up, hiring new employees and training them. And then once the employees are trained, they will end up leaving the company and, working for somebody else, right? So these are the stock options, one of the tactic the company widely use, right, to retain their employees for the longer term, right? Now, how do they do that? So they say that if, any employee, continues the successful 3 years with the company, then he will be awarded, say, 100 shares of the company, right? So this is how these plans are generally structured, right? You must have already had a discussion under India's 102, right, about the accounting and, presentation disclosure of all these ESOPs, right? Now, for a limited purpose, here we are going to talk about how these needs to be adjusted for EPS DPS calculations, right? So employees share options with fixed or determinable terms and non-vested ordinary shares are treated as options in the calculation of diluted earning per share, even though they may be contingent on vesting, right? So the company doesn't know whether the employees will actually continue with the company for the 3 years and will be getting those shares or not, but management can assume that they will be vested to the employees, right? And hence, basis on this assumptions, they are treated as outstanding on which date? The grant date. What is the grant date? What is the grant date as per India's 102? So are you able to recall? There were three dates. First was the grant date, right? Then exercise date, right? And in between to these, there was some vesting date, right? So grant date means when the company communicates the ESOP plan to the employees and employees agree to that plan. So that is the grant date where both the parties agreed to this ESOP plan or has a shared understanding, right? So 102 uses the word shared understanding, right? Then vesting date is the date when the employee is satisfied the condition, right? Vesting conditions, which is completion of 3 years with the company. So on the completion of 3 years, these shares or options assumed to be vested to the employees. Now, after the vesting date, the date on which the 3 years are completed by the employee, then there is an exercise date, the date on which employee actually, ask the management to issue the shares to their demat account, right? So this is the date on which the employee exercises, its option. So these are the three dates you must have discussed under India's 102, correct? Now, we are not worried about the exercise date or the vesting date, right? Because India's 33 says that these options are considered outstanding on the grant date, right? So on the date when the plan was offered to the employees and employees understood the plan and both the company and the employees have agreed upon or has a shared understanding. So on that very date, these shares are treated as outstanding for the purpose of calculation of diluted earning per share. Performance-based employee share options are treated as contingently issuable shares because their issue is contingent upon satisfying specified conditions in addition to the passage of time. So, as I previously mentioned, under India's 102, you must have studied performance conditions, right? Performance conditions are the conditions which are over and above to the vesting period condition. So there are two conditions: vesting period conditions, that is employee to continue with the company for 3 years, 4 years, 5 years, as the case may be. And in those 3 years, 4 years, 5 years, company's sales reach from this number to this number, or company's profits reach from this number to this number, right? So that can be an additional performance conditions which might be there in the ESOP plan. So if there are any such performance conditions over and above to the vesting period condition, then these ESOP options are considered as contingently issuable shares, because they are also dependent whether the additional condition is satisfied or not, and that is uncertain as on today. Management cannot say that after the 3 years company will be able to achieve 150 crores of revenue. We cannot say. Even if we have already achieved 140 crores and only 10 crore is left to be achieved in the third year, even then we cannot sure shot say that 10 crore will be achieved, right? So we don't work on the management estimate basis for the purpose of calculation of diluted earning per share, right? So we need to ignore those ESOP plans who have the vesting period condition as well as the performance condition. But we need to consider those ESOP plans which do not have the performance conditions and only have the vesting conditions, which is just a passage of time, right? So passage of time can be considered for the purpose of this India's 33 calculation. So that's why standard says these shares are treated as outstanding on the grant date itself, right? Let's do this. Profit attributable to ordinary equity holders of the parent entity for the year is 12 lakh. Weighted average number of shares outstanding is 5 lakh. Average market price of one ordinary share during the year is 20. Weighted average number of shares under the option during the 2001 is 1 lakh shares. Exercise price of the share under the option is rupees 15. Calculate the diluted earning per share. So under the ESOP plan, 1 lakh shares are expected to be offered to the employees who will complete the 3 years period, right? And there are no additional performance conditions. Do you want to try?
Yes.
Okay, go ahead, please.
The 2.4 is basic earnings per share.
2.4.
And 2 would be the diluted.
2. Okay. Any other answer? So simple maths will not work always. Profit attributable to the ordinary equity holders of the parent entity for the year 2001 is how much? 12 lakhs is the earnings given in the question, correct? and weighted average number of shares outstanding during the year given is 5 lakh. So 2.4, right? So basic earning per share is fine. Correct? Now, when we calculate the diluted earning per share, we need to compute the weighted average number of shares for the diluted earning per share denominator. So weighted average number of shares would be computed as follows. So shares under the option is how many? 1 lakh, right? And weighted average number of shares that would have been issued at the average market price would be 1 lakh into my 15 divided by 20, 75,000. So how many will eventually be issued for a free? So 1 lakh minus 75,000 is equal to 25,000. Correct? Are you able to recall the discussion we had today? That whenever the shares are issued to any party at a reduced price, then what is the benefit is being passed on to that person in terms of value divided by the fair market value should be the number of shares. Coming slide. Here. This is slide we discussed today, right? So first of all, whenever any instruments are dilutive, they would result into the issue of ordinary shares for less than average price, right? So what is my average price? 20 rupees. At what exercise price employees are getting the shares? 15 rupees. So how much benefit is being passed on to the employees? 5 rupees. So 5 rupees for each share is a benefit. So 5 rupees into my total number of shares divided by the fair market value, right? So 1 lakh shares into my 5 rupees divided by 20 rupees, 25,000 are the number of shares equivalent to this benefit, which is being issued for no consideration to the employees. Is that clear?
Clear.
Right. Now, once we have computed how many shares are actually getting issued for zero consideration, that is 25,000, then that 25,000 only needs to be added in the calculation of weighted average number of shares calculation for the purpose of diluted earning per share. That's what this slide says. So the shares which are getting issued at fair price, how many? 75,000. Are anti-dilutive or dilutive? None, because they are issued at fair price. So they are ignored for the purpose of calculation of diluted earning per share. And how many are issued for a free? 25,000. So 25,000 are considered to be dilutive, right? And hence they are adjusted. Clear?
Clear.
So now we will remember this important aspect about the weighted average number of shares calculation whenever the shares are being issued to employees or to any third party at a reduced price as compared to the fair market value. Is that clear? So it doesn't matter who the party is, right? Why we forget about this concept? Because we thought these are our employees only, right? And we are actually giving them 1 lakh shares. No, we are not giving them 1 lakh shares for a free. How many shares we are giving for a free? Only 25,000. Remaining 75,000 are getting issued to them at a fair market value, right? And if something is issued at a fair market value, then that needs to be ignored completely for the purpose of calculation of weighted average number of shares for diluted earning per share computation. Is that clear now?
Yes, clear.
So now what would be the answer? Diluted earning per share 12 lakhs divided by 2.29. Why there is no adjustment in earnings? Because neither the employees were getting any dividends on these employee stock option plans nor any other benefits in the form of interest or anything premium or discount, right? Nothing else. So the only denominator will be impacted. Clear? And what the assumption played here? Are the 3 years past today? No. The assumption India's 33 is taking is they are treated as outstanding on the
Granted.
Granted. So we will not do any periodic adjustment that how many shares are getting issued in first year, second year, third year. If it is a graded vesting, no, it doesn't matter. We will only see how many total shares will eventually be issued to the employees and that are considered outstanding on the grant date, provided there are no performance conditions, right? If performance conditions are there, then they will be covered under the concept of contingently issuable shares. And contingently issuable shares treatment is whenever the event occurs, then only we will consider them. Until then, we will ignore. Clear?
Clear.
Okay. Entity with discontinued operations. An entity that reports discontinued operation should use income from continuing operations adjusted for the preferred dividends and similar adjustments, if any, as the control number in determining whether the potential common shares are dilutive or anti-dilutive, right? So here is the rule book, which we have already discussed and understood. So whenever the entity has the discontinued operations, it means the entity has both continuing operations as well as the discontinued operations, correct? Now, because the company is having discontinued operations, then we have to, first of all, decide upon the dilution or anti-dilution on the control number. And what would be the control number? Control number would be the basic earning per share from continuing operations. If that is getting diluted, then dilutive earning per share is there. If that is not getting dilutive, then for discontinued operations, diluted earning per share will not be calculated, even if it is dilutive, right? That's what we have discussed before the break. Now, it means the same number of the potential common shares used in computing the diluted earning per share of income from continuing operations should be used in computing all other reported diluted earning per share amounts, even if the effect will be anti-dilutive compared to their respective basic per share amounts, right? In our example, when we did this continuing discontinuing example, so what we have learned, so the rule book is continuing operations, discontinuing operations, and the total operations, right? Now, basic earning per share and per share, right? So this is the matrix which we are talking about, right? Now, in case the company has the discontinued operations, then company needs to present continuing, discontinuing, total, right? Now, in this case, if from my continuing operations, the basic earning per share is say rupees 3 and diluted earning per share comes say to rupees 2.5, then it is dilutive or anti-dilutive?
Anti-dilutive.
Anti-dilutive. So it means uh, I am calculating the diluted earning per share. Sorry, 2.5 is here. By mistake, I wrote here, right? So it is dilutive, right? So from continuing operations, if it is reducing because my continuing operations are profitable, then I will calculate for diluted earning per discontinued operations and the total operations in a similar fashion using the similar base, right? Now, if my continuing operation is -3 and my diluted earning per share is coming say -2.5, then it is dilutive or anti-dilutive?
Anti-dilutive.
Anti-dilutive. So in this case, what I will say, I will ignore -2.5 and I will say it is -3 only. Correct?
Yes.
Right? Now, because at the control number, this is giving me an anti-dilution. So at a discontinued operation or as the total at the total operation, I will continue to use the same number of weighted average number of shares for the calculation, right? So that's what this rule read. Clear? So I will not adjust the additional number of shares for the purpose of calculating diluted earning per share for discontinued operations or total operations anyway, if my control number is getting anti-dilutive, right? So my denominator will be constant. What I am using for the continuing operations will continue to be used for discontinuing and the total operations, right?
Yes, right.
This numerical we have already done. Okay. Next item, written put options. But before I, start with the written put options, any questions anybody wants to ask until now, whatever we have discussed so far since morning? Clear everything? Okay, so silence means no questions.
Yeah, sir.
Yes.
Same number is used for continuing operations denominator and
Yes.
discontinued operations and for calculating diluted earning per share in case
Correct.
of anti-dilution.
Correct. So the rule is, if my control number, that is the basic earning per share at the continuing operations, is becoming anti-dilutive, then I will not make an adjustment to the denominator. Clear?
Okay. Please.
Perfect. Okay. Written put options. So call options, put options. So again, there is a matrix. So there are call options and there are put options, right? Call means right to buy. Put means right to sell, right? So call means I want to buy the shares of the company. I have the right to buy the shares, call option. Right to sell, I can sell the shares of the company. Right to put them back to the management, right? Or right to call from the management. Clear? Now, if there is a holder of the call option, right? So it can sell that call option. And if there is a holder of put option, then it can sell the put option. So when somebody sells the call, so somebody buys the call and somebody sells the call, right? So when he buys the call, it is called buying a call. When somebody buys the put, it is called buying the put. When somebody sells the call, it is called writing a call option, right? So sells means writing, right? And when somebody sells the put option, it means writing the put option. Now, let's understand these four options first. Suppose Mr. A purchases a call option to buy 1,000 shares of the company at the rate rupees 20, right? And the call he has purchased is, say, rupees 2. So 2 rupees he has paid for each option into a 1,000. So 2,000 rupees he has paid, right? Now, by paying these 2,000 rupees, he has the right to purchase the 1,000 shares of the company at the rate of 20. 20 is the strike price, right? This is how call put options work in the market. If you ever got a chance to see how they are operating in the market, did you see any call options, put options by any chance? Yes, no?
Not actually.
Okay. Then because Mr. A has bought by paying rupees 2 for 1,000, so total 2,000, then there must be somebody, say Mr. Y or Mr. B, right, who has sold this to Mr. A, right? So to take a trade, there must be a second party. So if one person is buying something, then there must be another person selling that. Yes or no?
Yes, that's right. Yes.
So Mr. A is buying a option which gives Mr. A the right to purchase the shares of the company at rupees 20, and the premium for buying this call option he has paid is rupees 2, and the 1,000 is the number of options, right? One option is equivalent to one share. So 2,000 rupees he has paid to Mr. B, and Mr. B agreed that in case Mr. A wants to buy 1,000 shares at 20, Mr. B will pay or give the shares to Mr. A. So that's the contract between Mr. A and Mr. B. Now, in this case, Mr. A is the option buyer and Mr. B is the option seller, right? So what eventually is happening? Mr. A is getting the right to ask for shares of the company, and Mr. B is getting the obligation to give or provide the number of shares Mr. A is asking for. Correct? So Mr. B is writing a call option here. Clear?
Clear.
Now, instead of the call option, Mr. A said, boss, I am not interested in buying the shares, but I am interested in selling the shares. So I am buying a put option. So now Mr. A is buying a put option. Put means that I have the right to sell the shares of the company, right? So Mr. B said, okay, no issues. I will, agree upon with this trade. So again, Mr. A is a buyer only, but buyer of what? Buyer of put. And Mr. B is again the seller, and but not seller of call, but seller of put, right? Now, what's the contract is? The contract is Mr. A says that I want to sell the shares of the company at rupees 20. And Mr. B said, okay, no problem. You want that right? I am ready to, sell that right to you, right? So Mr. A has the right to sell the shares, and Mr. B has the obligation to purchase those shares from Mr. A. Because it has sold that right to Mr. A, eventually it is agreeing to buy the shares which Mr. A wants to sell at rupees 20, right? So this is how the right to call, right to sell, that is buy the call, buy the put, and right to obligation to buy and obligation to sell means writing the put or writing the call, right? So this is how this contract actually plays in the real world. Now, what we need to do with this concept for the purpose of calculation of our earning per share. So this is the market concept. Anyway, it is not going to impact your earning per share. That's I have just discussed for your understanding what call or put option means. But instead of the market player, if one party to this arrangement is the company and the another party is, any person, then if that person has the right to purchase, then company needs to issue the shares. And if that person has the right to surrender the shares to the company, then company needs to buy back those shares, right? So in that case, what will eventually happen? Either the company will end up issuing additional shares if that person exercises the call option, and company will end up buybacking or doing the buyback of the shares from the holder of shares if the company if the other person has the put right, right? So in this case, the company, if issues the share, will increase the weighted average number of shares, and if it does the buyback, it will reduce the weighted average number of shares. Until now, are we on same page?
Yes. Yes.
Right? Now, let's read what the standard says. Contracts that require the entity to repurchase its own shares, the shares which have originally been issued to the shareholders now are being bought back by the company, such as written put options and forward purchase contracts are reflected in the calculation of the diluted earning per share if the effect is dilutive. If these contracts are in the money during the period, that is, the exercise or settlement price is above the average market price for that period, the potential dilutive effect on earnings per share shall be calculated as follows. 1. It shall be assumed at the beginning of the period sufficient ordinary shares will be issued at the average market price during the period to raise the proceeds to satisfy the contract. Then, second assumption, it shall be assumed that the proceeds from the issue are used to satisfy the contract, that is to buy back the ordinary shares. And third, the incremental ordinary shares, the difference between the number of ordinary shares assumed issued and the number of ordinary shares received from satisfying the contract, shall be included in the calculation of diluted earning per share. कुछ समझ में नहीं आया, राइट? स्टैंडर्ड ने क्या कहा? So let's do the numerical first. What the standard is saying, let's understand with the numbers. Then we will read the literature again. Assume an entity has 160 written put options outstanding on 160 of its ordinary shares with an exercise price of rupees 10 per share or 10 per option. What this means? So here what is happening? Entity has 160 put options sold to the other party, right? So there is a company A, that is ABC Limited, for example, right? And Mr. X is the person, right? Now company and Mr. X have entered into a contract, right? Whereby ABC Limited agreed to buy back 160 of its shares from Mr. X, right? Because it has written a put option. Written a put option means sold a put option. Selling a put option means getting into an arrangement where effectively you will be the buyer of the shares, right? So 160 written put options outstanding on 160 of its ordinary shares with an exercise price of rupees 10. So at what price the company has agreed? So company is saying to Mr. X that Mr. X, if you want to return the shares you hold for the company, then you can do so at the rate of rupees 10 for how many shares? 160 shares, right? So for each share, ABC Limited will pay 10 rupees to Mr. X, and Mr. X will surrender 160 shares for rupees 10 each to ABC Limited in case Mr. X wants to do so, right? So that is up to the will or wish of Mr. X. This is the contract. Now, put obligations value is how much? 1600. 160 into 10, 1600. So this is the value of the put option. Average market price of entity's ordinary shares is rupees 8 for the period, right? So 8 rupees is the prevailing market price of the company ordinary share. If the company is listed exchange, then from exchange it we will be able to get it. And if the company is not listed, then fair value can be done, right? So in either case, 8 rupees is the fair market value of the company's one share. In calculating the diluted earning per share, the entity assumes that it issues 200 ordinary shares at rupees 8 per share to raise the proceeds necessary to satisfy the put option. So in order to arrange 1600 rupees, how many shares company will need to issue if the company wants to have 1600 rupees, right? So 1600 divided by 8. How many shares? 200 shares. So company suppose Mr. X has come to the company and says, boss, here is the put contract which you have agreed upon with me, and I want to offer these 160 shares at rupees 10. So take these 160 shares at rupees 10 and give me 1600 rupees. Then company says, oh, we don't have cash of 1600 rupees. We need to arrange that cash, right? So in order to arrange that cash, let's issue more shares in the market to some other shareholders, right? So I asked Mr. X, wait at the reception, let me issue some shares, arrange the cash, and then I will pay back to you, right? So Mr. X is having a coffee at the reception and the management is busy in arranging the cash by way of issue of fresh shares. How many fresh shares the management is issuing now?
200.
200 shares, because in the market the price is 8 rupees only. So who will be buyer for beyond 8 rupees, right? So anybody can invest at the fair market value only, right? If company offers at rupees 10, then whether somebody will buy? No,
No.
right? So at 8, how many shares? 200 shares. Now the difference between the 200 ordinary shares assumed to be issued and the 160 ordinary shares that would be bought back from Mr. X, that is delta is how much? 40 shares.
40.
Yes or no?
Yes, 40 shares.
Now, this 40 share will be additionally issued. So, suppose my original number of shares were say 10,000. Then I have bought back from Mr. X how many? 160.
160.
And how many I have issued to arrange the cash, which I eventually
200.
paid to Mr. X? 200.
200.
So, my closing number of shares would be how much? Yes or no?
10,040. Yes.
10,040, right? So that's what the 40 shares are added to the denominator, that is number of shares in calculating the liability earning per share. No adjustments to the numerator because nothing is happening to my profits, right? So numerator will remain same, denominator will be increased by the delta of the shares issued over and above to the shares bought back. So that's
The
what
shares
the
are
standard says.
shares are bought back at 10 rupees and the market
Okay,
price is 8 rupees. So wouldn't that be a loss to the
right.
company? Notional.
Of course. It will be because company is doing a issue at 8 and buybacking the shares at 10, right? So anyway, it will be a loss for the company. But in this transaction, actually loss is not, happening because this is a equity transaction, pure equity transactions. So I'm issuing some shares at certain price, I'm buybacking the shares at certain price, and under Ind AS 109, you must have studied for equity transaction, PNL is not affected, right? So if I'm issuing the shares at a premium, whether I record that premium in my PNL, no, that goes to where? Security premium account, yes or no?
Yes, but
Reserves.
109 not done yet.
Reserve. Even okay, forget about 109. So generally when the company issues the shares at a premium, then premium is recorded in the PNL or at the securities premium reserves account?
Securities premium account. Yes.
Reserves account, right? Similarly, if
Reserve.
the company offers the shares at a discount, it is recorded in the PNL or it is treated from deducted from the reserves,
Reserves.
right? So 109 under Ind AS says whenever the company does a equity transaction means whenever any equity shares are either issued by the company or are bought back by the company, then any profit or loss on these transactions are never recorded in the PNL. They are always recorded in equity only, right? Adjusted within the equity, right? So PNL is not affected at all. Hence, there wouldn't be any adjustments to the profit and loss attributable to the ordinary shareholders, right? So numerator will remain unaffected, only the denominator will change, right? So that's what the adjustment we need to do in case there are any written put options. Now, what is written put option? Written put option is the option where the company has agreed upon with any investor to buy back the shares from the investor in case investor wants to surrender. That is the written put option by the company in plain simple language, right? Where the company is obliged to do the buyback if investor knocks the door of the company for surrendering the shares. Is that clear?
Yes, clear.
Right? Now let's get back to the literature. And now we will read the literature carefully and understand whatever the adjustment we have calculated in the example is actually if somebody wants to give a words to this, then how it will be presented. So standard says denominator should be adjusted for the potential dilutive effect as follows. A, it shall be assumed that at the beginning of the period, sufficient ordinary shares will be issued at the average market price to raise the proceeds equivalent to satisfy the contractual obligation, right? So how much contractual obligation in example the company had? 160 rupees, or sorry, 1600 rupees, right? To satisfy the contractual obligation, 1600 rupees. How much cash the company needs to raise? 1600. And how it will be raised? By issuing sufficient ordinary shares at fair market price, right? And what is the fair market price? 8 rupees. Sufficient ordinary shares will be at fair market price. So 1600 divided by 8, 200. First line is clear.
Yes, clear. Yes.
Second, it shall be assumed that proceeds from the issue are used to satisfy the contract, that is to buy back the ordinary shares. What does this mean? That we are not raising or issuing any additional shares, right? So although we have the contractual obligation of 1600 and management can think अब issue करने बैठे ही हैं, so instead of issuing only these 200 shares, let's raise more funds, right? So no. So the standard is assuming that whatever is the contractual obligation amount, the number of shares should be issued only for that very purpose, right? So it shall be presumed that the proceeds from the issue are used to satisfy this contract only and not any other purpose, right? So that much cash only we are raising by the issue. Clear? Second one. Third, the incremental ordinary shares, that is the difference between the number of ordinary shares assumed issued, that is 200, minus the number of ordinary shares received for satisfying the contract, that is 160, is equal to 40, shall be included in the calculation of diluted earning per share. Clear?
Clear.
So, in the example, if somebody was reading this plain vanilla language, it was difficult to arrive at, the interpretation. But with the help of example, now we have understood. So, 3 rules. Number, how much the contractual obligation we have for the buyback in case some investor comes to our door to surrender their shares. That obligation divided by the fair market price. How many additional number of shares we need to issue to arrange that much cash in order to settle that obligation. That cash, we need to raise only for this contract purpose, right? So we are not raising any additional cash, right? Now, how many number of shares we are issuing for this purpose minus how many shares we are actually ending up with the buyback. The data, the additional number of shares will be added to the denominator for the purpose of calculation of diluted earning per share. Now, again, the same thing I want to repeat. Is the buyback happening in real world? No. Is the additional issue of shares happening in the real world? No. It is only hypothetically we are assuming that investor is coming for the buyback and company is issuing additional share to raise the proceeds. Then what would be the additional shares the company will be issuing to adjust for our denominator for the purpose of calculation of diluted earning per share? Neither the buyback is happening nor the issue is happening. No transactions are happening. No accounting is happening, right? Only the calculation happening in our working note. Clear?
Clear.
Until now, all the discussion we had for the purpose of calculation of basic earning per share and diluted revolved around calculation of weighted average number of shares, and we have never thought what if those shares are partly paid. Possible, not possible?
Yes, possible.
Possible, sir.
One more angle, right, for the calculation of weighted average number of shares. Sometimes company issues shares, say 10,000 shares at the rate of face value of rupees 10 each, right? at a premium of 30, right? So total money the company will be receiving is how much? 40, right? So ideally, how much money the company should have received? 4 lakh,
Yes, 4 lakhs.
right? But because company has not yet received the full application money, or company has not called the full money, and they are issued at, say, instead of 40 at only 20, and 20 rupees is pending, right? So 20 is received and 20 is pending, correct? Then how much cash company has received? 2 lakh,
Yes, 2
right?
lakhs.
So instead of receiving the 4 lakh, the company has only received 2 lakh. Now, because the company has received only 2 lakh against 4 lakh, so can I say the partly paid shares 10,000 or fully paid shares 5,000,
Yes,
Yes, sir.
right? So what do you think? Should I calculate my earning per share basis on the 10,000 number of shares, or basis on the 5,000 number of shares which are fully paid?
5,000 fully paid.
I got
5,000.
5,000 fully paid.
Right? 5,000 fully paid. So that's what the standard says. Standard says when ordinary shares are issued and are not fully paid, they are treated in the calculation of basic earning per share as a fraction of an ordinary share to the extent they were entitled to participate in dividend during the period relative to the fully paid ordinary share. So this is the typical language, right? But what actually we are going to do, let's understand. An entity issues 1 lakh ordinary shares of rupees 1 each for a consideration of rupees 2.5 per share, and 1.75 out of the 2.5 per share was received and by the balance sheet date. The partly paid shares are entitled to participate in dividends for the period in proportion to the amount paid. Calculate the number of shares for the calculation of basic earning per share. So how it will be calculated? 1 lakh into how much monies we have received, divide by how much monies were expected to be received. So 70,000 is the shares which we use in the denominator as the weighted average number of shares for the purpose of calculation of earning per share, right? Clear concept?
Clear.
Yes, yes, sir. Even when the shares are partly paid, but they have the entitled to participate in the dividend fully. Then we will take the
Mhm.
full shares, na?
Yes. So generally it doesn't happen, right? If the shares are partly paid, then it doesn't happen in general, right? So it, if it is there, then certainly we don't need to do this adjustment, right? Because anyway each shareholder is entitled, you know, with full vote and full rights to the dividends, right? So if it is entitled to full profits or full dividend rights, then anyway we will consider the whole number, right? But how can it be possible that company has received, yes, say 60% of the amount and will be ready to pay the 100% of the dividends, right?
Yes.
So these were all the important items under India's 33, which you know we discussed. Any queries, doubts, questions you have until now? Because largely, the discussion is over. Now we will talk about the presentation and disclosure requirements, and then we will see the sample disclosures, and then we will see the comparison with Indian GAAP and the IFRS, and then we will do some MCQs, right? So, but before jumping to this section of the session, any queries, anything anybody wants to ask? No, everything is clear. Perfect. Okay, nothing in the chat box too. Okay, so let's see how presentation requirements are under India's 33. So India's 33 says present in the statement of the profit and loss, the basic and the diluted earning per share for the profit and loss from the continuing operations for each class of the ordinary shares, right? Then earning per share is presented for every period for which the statement of profit or loss is presented, right? So if the P&L is prepared for the half year, EPS would be for the half year. If the P&L is prepared for the 9 months, EPS would be for 9 months. If the P&L is prepared for 3 months, then EPS would be for 3 months. If diluted earning per share is also reported for at least one period, it shall be reported for all the periods. So, if the company is preparing the financial statements for the current year and they are also presenting the comparative year, then if the diluted earning per share is being computed for the current year, then it also needs to be presented for the previous year. It cannot happen that we present it only for the current period or for any period for which we want to present. No. So if it is applicable, then it needs to be presented for all the periods presented in the results. If the basic and diluted earning per share are equal, in which scenario it will be equal? When the instruments are not dilutive, rather anti-dilutive. So if the instruments are, then basic and dilutive will be equal, right? Then standard says instead on the face of the P&L by presenting basic earning per share and diluted earning per share as like this, we can do basic and diluted earning per share like this in the single line item, right? So standard says if the basic and diluted earning per share are equal, dual presentation can be accomplished in one line item in the statement of the P&L. Clear?
Clear.
So is it prohibited or is it allowed?
Allowed, optional.
Allowed. So optional. So if company wants to do this, they can do this. But if company doesn't want to utilize this option, they can continue with this, right? An entity that reports a discontinued operation shall also disclose the basic and diluted earning per share for discontinued operations either on the face of the P&L or somewhere in the notes to accounts. Clear?
Clear.
So discontinued operations EPS is not required to be presented mandatorily on the face. It can be presented in the notes to accounts. An entity shall present the basic and diluted earning per share even if the amounts are negative. So does the company loss-making companies have a choice to skip the earning per share presentation? No. If the company is profit-making or loss-making, that doesn't matter. Earning per share reporting is mandatory. Clear?
Clear.
Now, what additional disclosures? So this is about presentation. What are the disclosures? So disclosures are basic and diluted earning per share with equal prominence, even if the company is loss-making and for each class of ordinary shares, right? So this needs to be disclosed. Then amount used as a numerator and the reconciliation to the P&L as so earnings attributable to the ordinary equity shareholders, whatever the adjustments we have come up with, right? So we started with the profit after tax, then we did some adjustments, and then we came to the profits available for ordinary equity shareholders. So this reconciliation needs to be disclosed in notes to accounts. Similarly, weighted average number of shares, ordinary shares used as denominators for the basic and the diluted, and the reconciliation of these to each other should be disclosed. Now, instruments including contingently issuable instruments. Contingently issuable instruments are the ones which are contingent upon the occurrence or non-occurrence of an event which will take place in the future. That could potentially dilute basic earning per share in the future, but were not included in the calculation of diluted earning per share because they are anti-dilutive for the periods presented. So if there are any such instruments which we have not considered because they are anti-dilutive, then in the notes to accounts, we need to disclose all these anti-dilutive instruments list so that investors can come to know which all anti-dilutive instruments the company has, which are not considered for the purpose of diluted earning per share because they are anti-dilutive, right? Then a description of ordinary share transactions or the potential ordinary share transactions other than those arising from capitalization, that is bonus issue, or share split, or the reverse share split, that is consolidation, that occur after the reporting period and that would have changed significantly the number of ordinary shares or potential ordinary shares outstanding at the end of the period if those transactions had occurred before the end of the reporting period. Very complicated. So let's understand this disclosure from an example. Suppose there was a company which is coming up for the IPO, initial public offer, right? Before the IPO, the company has a number of shares, paid up equivalent number of shares. How many? 8,000 number of shares of rupees 10 each. Suppose 80,000 is the paid up capital, right? Now, because the company is launching its IPO, so they are offering 5 lakh shares of rupees 10 each, right? So 50 lakh share capital, right? So post IPO, how much the capital would be? 50 lakh 80,000? Yes or no?
Yes.
So the company who was having 80,000 share capital with 8,000 shares will have 50 lakh 80,000 capital with 5 lakh 8,000 shares, right? So don't you think that companies number of shares are increasing significantly because of
Yes.
this IPO? Yes. Now, if this IPO is taking place in the April month, right, and we are preparing the financials for 31st March. So for 31st March, how many shares you will consider for the purpose of calculation of earning per share and diluted earning per share? 8,000 or 5 lakh 8,000?
50 lakh 80,000.
How come? So IPO transaction is scheduled in April, right? This is not scheduled in March, right? So in March, the transaction is not happening. How many shares in issue we have? Only 8,000,
Yes, 80,000.
right? So
8,000.
for 31st March, we will use 8,000. But because IPO, we know while preparation of the financial statements that is taking place in April, yes or no? Yes.
Yes.
And users of the financial statements should be made aware that company's earning per share is calculated using the 8,000 shares while it will be 5 lakh 8,000 after the IPO, right?
Yes.
So this is the disclosure which we need to make. So if the company is coming up with IPO or FPO, which will increase the issued share capital significantly as compared to what the company has, then this disclosure, additional disclosure, we need to give in our financial statements that post this transaction, our number of outstanding shares will be increased significantly and the revised number would be this, right? Then disclosure. Whenever we are preparing the annual financial statements, we need to present basic earning per share and diluted earning per share. All periods with the statement of comprehensive income or a separate statement under Ind AS 1 presented or interim financial statements, quarterly or half yearly, right? So whether the company is preparing the quarterly financial, half yearly financial or annual financial or any other period financial, suppose company comes up and says we are preparing the 9-month financial, then EPS will be presented or not?
Yes, present.
Presented. So there is no exemption relaxation from the presentation of the EPS basis on the periodicity of the financial, right? So periodicity or the duration doesn't matter. Additional disclosure. Basic and diluted earning per share are adjusted for any errors, changes in accounting policies, right? If there are any, as per the Ind AS 8, right? So if there are any error corrections have happened during the current year, or any changes in accounting policy has taken place, then it will be adjusted for all those items, right? Anyway, because whatever the error correction has been done or change in accounting policy has been done, it will automatically reflected in my PNL.
Yes.
And I am taking the base of the PNL as well to start with for the calculation of earning per share, diluted earning per share, right?
Right.
Securities that are anti-dilutive but could dilute EPS in future. So today they are anti-dilutive, but in future they may change their color and they may become dilutive. So those securities I also need to mention in my disclosure separately, that for March 2025 financial, this is anti-dilutive, but they may become or turn dilutive in future, right? These are the sample disclosures. Basic earning per share, right? Current year, previous year. Before, so there is an exceptional item as well in this company's case. So that's why they have presented after exceptional, before exceptional, and diluted after exceptional, before exceptional, right? And then they have, presented the significant accounting policy and notes, right? Then
Is it required to show the basic and diluted before exceptional, after exceptional, as per
yes,
standard?
in case you have the exceptional item,
Okay.
right? Otherwise not, right? Then first of all, I will say what is my face value of the share. Then before and after exceptional item, what is my basic and diluted earning per share. Then whatever the net profit after tax, right? After exceptional or before exceptional, and then weighted average number of shares, which I have calculated, right? So I will present these items, and then I will calculate the diluted, right? And then I will say whatever the profits are available with the reconciliation, right? To the weighted average number of shares which I have computed, right? So 659, how become 668? I need to give that reconciliation. And then also I need to present, the weighted average number of shares which I have used for denominator. Okay, so this reconciliation is basically presented here, right? So 659 is the used in basic, 835 is the additional, and 668 is the denominator for diluted, right? So this is how I'm going to present. So that was the disclosure. So the only disclosure is basic earning per share, diluted earning per share, the reconciliation of the numerator and the denominator, and list of anti-dilutive instruments, list of instruments which are anti-dilutive today but may turn dilutive tomorrow, right? So these are all disclosures. Now, what are the differences between the Ind AS and the IGAP? EPS presentation. Ind AS 33 says present requires separate basic and diluted earning per share presentation from continuing and discontinuing. AS20 is silent. Sorry, this is not AS20, right? This is a error. So AS is silent. No such requirement to present from continuing and discontinued. Then must be included in the calculation of basic earning per share from date of contract entered into, no guidance, right? So for all the mandatorily convertible instruments, be it the debentures, bonds, or preference shares, right? It must be included in the calculation of basic earning per share from the date the contract has been entered into. This is clearly specified by Ind AS 33. But under the IGAP, standard has been silent on this. So we have been doing the same thing, but the standard is not expressive on this, right? Contingently returnable shares. So this is the, again, Ind AS 33 is trying to be expressive here. AS or IGAP is silent on this. They are not rated as outstanding and are ignored for the calculation of basic earning per share until they are no longer subject to recall. Are you able to recall this discussion we did in the first class? Contingently returnable, contingently issuable shares, right? Then what are the differences between Ind AS and IFRS? Ind AS says where any item of income or expense which is otherwise required to be recognized in the P&L in accordance with the Ind AS debited or credited to the securities premium account or other reserves P&L from the continuing operations should be adjusted for the purpose of calculation of basic earning per share, right? IFRS has no such requirement. But what is this? So this is Ind AS 33 says if there is anything which needs to be recognized in the P&L, but management has not recognized that item in P&L, but has debited or credited in some reserves account, then for the purpose of calculation of earning per share, this needs to be adjusted, right? But IFRS says why the management will do so? Because management is not allowed to record any transaction which is required to be accounted for in P&L in the reserves, right? Same rule is applicable for the Ind AS too. So if Ind AS says that any particular item needs to be recorded in P&L or any particular item needs to be recorded in OCI, then we are bound by that. We cannot take an exception to that. But still, just to be doubly safe, Ind AS 33 says in case there is anything which otherwise needs to be recorded in the P&L is not recorded in the P&L but debited or credited in some reserves, then this needs to be considered or adjusted for the purpose of calculation of earning per share, right? Although you will not find any such situation. Okay, let's try our hands on these few MCQs. As per the Ind AS 33, shares issued in exchange for settlement of a liability are included in the EPS calculation from which date?
From the settlement date.
Perfect. Are you able to recall that slide which we discussed in the last session, where
Yes.
there were numerous items and against
Yes.
those the date which needs to be considered was mentioned, right?
Yes.
So for the liability settlement, it would be a settlement date. According to Ind AS 33, earning per share, an entity shall present basic and diluted earning per share even if the amounts are negative. True or false?
True.
True. No relaxation exception for the loss-making company. Otherwise, the loss-making company will skip to present the EPS or earning loss per share, right? So whether the company is loss-making or profit-making doesn't matter. Every company needs to disclose the basic earning and diluted earning per share. M Limited reported a profit of rupees 2 lakh for the year ended 31st December 2012 and total number of shares outstanding are 20,000. On 30th June 2013, it announces that it will split one share into 5. So as a result of the share split, the shareholder received additional 4 shares for which the shares previously held. You are required to calculate the basic earning per share for the year 2012. Simple, you can do it. Share split is treated as like a bonus
True.
adjusted from the day one, that is the inception date, or for whole of the period, right? So what we will do, we will simply increase the number of shares, correct?
Yes, sir.
Correct. Yes.
As like a starting date and divide it.
Correct. When an undertaking presents both consolidated and separate financial statements, the disclosure required by Ind AS 33 required to be presented mandatorily for both sets of statements, only for consolidated, only for separate, or either in consolidated or separate, elected by the entity.
Both.
For both sets of statements, right? Because in the very first class, we discussed that if the company is preparing separate financial statement shows the profitability at standalone level, right? So at a standalone level, what is the EPS measure needs to be presented. And when the company has subsidiaries, JVs, and associates, it prepares the consolidated financial statements, right? So at the consolidated level, the earnings of the company are different, right? So it needs to be presented for the consolidated earnings per share as well, right? So for both sets of financial statements, consolidated as well as separate, EPS disclosures are mandatory. So that was it from my side on Index 33. I hope the session was
Recording
informative.
stopped.
अरे
Recording in progress.
होस्ट नहीं है तुम? Okay. Good morning, students. Sir, just 1 minute to conclude.
Sure, please.
Students, one more announcement. Those who are also attending LVRC classes along with this class, I would just tell you one thing, that we have scheduled our Wednesday. We have preponed our one class which was scheduled on Wednesday. That was on 19th November. That we have preponed it to 17th November, Monday. That class will be a revisionary class on income taxes in days 12. So those who are interested in joining the LVRC, they should take note of this. One thing. Another thing, that as you all may be knowing, that for January 2026, we are conducting a virtual webinar on a fortnight basis for every paper, dedicated for every paper. We have started this from Tuesday on 11th November for final. It is 11th for financial reporting, it was there. Then it is on 13th, it was for AFM. Today it will be for AFM, advanced financial management. So, and these are for January 2026. They'll be, the faculty along with the expert will be there to guide you how to approach the examination, what are the important topics which to be considered, what are the important concepts within the topic which is to be considered, common mistakes which should be avoided. So those students, even if you are not attempting for January 26, I would request you all to attend that webinar. This is a virtual webinar starting from 3 to 5 p.m. and this will help you in preparation and for your readiness for your May 2026 examination. So please be attentive for that. And after that program, we would also request you to fill the feedback form for that fortnight program. Along with that, we again request you to fill the feedback form for this LVC class which we have today. And also for every session which we have, even in case that particular topic is running into 3 sessions, we request that for every session, if you fill the feedback form, it will be of help to us. Okay. Thank you, sir. Thanks a lot.
Thank you, ma'am.
Thank you, sir. Bye.
All the very best to all the students. Have a good day. Bye.
Thank you, sir. Thank you, ma'am.
Bye.
Thank you, sir. Thank you, ma'am.
Thank you. Thank you very much. अशोक जी बंद कर दीजिए. हाँ, have a nice. Thank you.